Hey there. Welcome to Motley Fool HQ. I am Dylan Lewis, and I'm joined by Robert Brokamp, CFP, Jason Moser, one of our senior analysts here at The Fool. We're going to be talking about one of the eighth wonders of the world, I guess the eighth wonder of the world, one of the wonders of the world, and how you can use it to help a big retirement nest egg. We've also got some savings tips and some ways to help you get there, places to put the money to make that happen. This video is really going to be an entree into the topic. We also have a big discussion of this in written form. You can catch that with our investing starter kit over at fool.com/start. Thanks for joining us, folks. All right, Robert, I'm going to start with you. Let's talk about this magic formula. I think it's probably one of the most important things when it comes to personal finances, probably one of the least understood.
Right. And what we're talking about here is compound interest. Like it really is the way to make your money make money for you. So I think a lot of people like to hear things in terms of metaphors, and I always think about it as basically a tree, right? When you invest your money, you're planting a tree, and that tree will grow. But it also produces seeds that allow you to plant other trees that will grow and produce seeds of their own. So given enough time, you really can turn one tree into an entire forest. That's the metaphor I like to think of. Mathematically, it comes down to three variables, right? It's the money you invest, the rate at which that money grows, and the amount of time. Put those three together and you get a pretty good idea of how much you could turn an investment today into something in the future.
And we're going to flash that formula up on the screen so people can see it. But I hope people aren't spooked by the idea of doing math. I mean, this is the kind of thing where you go to most personal finance investing websites, there is something there. There's a calculator that you can use to get a handle on this and the power that it has. Robert mentioned time. Jason, I think that that's probably one of the things that people have the most control over.
Yeah, I mean, that's something we talk about, certainly on the stock side of things. I mean, there is sort of this dichotomy between what's going on Wall Street, the information they get, and how quickly they get it, versus us here in Alexandria, Virginia. We're not necessarily getting all of that information as quickly. We have to have some sort of edge, and we refer to time, I think, as that edge for the most part, not to mention our business-focused investing mentality. But I mean, when we talk about compound interest, we talk about time. One of the slides that we use in our Fool School classes occasionally, which really I think hammers this point home, is we offer the students a choice. They could either have a scenario where they start with a penny and then they double that penny's value every day for 1 month. So on day one, it's a penny, day two, 2 pennies, day three, 4 pennies, then 8 pennies, and so forth. Or they could get $100,000 per day, every day for the month. Which scenario would you choose? And most of the time, the kids go for the 100 grand, right? I mean, it makes sense. It's a big number. They think, well, I mean, that's, $3 million. I'm going to have $3 million. In the penny scenario, you can't really plug your mind into how powerful that could be. But when you look at the actual number that comes out there, if you go with the penny scenario, after that 30 days, you've got $5.37 million. So substantially more than the $100,000 a day. And that is because of precisely what you guys were talking about, compound interest, that growth, your money making money on top of itself, more or less. And really, it shows itself the last 5 days of that month. It just kind of creeps along there, and then the last 5 or so days, it just booms straight up. So it is real. It is math. You don't have to memorize the formula. You really just got to start investing.
I know as investors, we love to see that hockey stick chart. Yeah. And this is the case here, right, where you have exponential growth. And actually, there's a bias. It's called the exponential growth bias that gets at exactly what you're talking about, JMO, where people have a really hard time conceptualizing that rapid growth on top of growth.
Yep.
So I know that not everyone has a lot of money sitting around, not a lump sum right off the bat, not $10,000 where they can immediately start enjoying the benefits of compounding. So if we put it in slightly different terms, if we say, okay, what if it's $200 a month? What might that become? You get $200 a month at 7% annually over 40 years. That gets you over $500,000, $500,000. Not too shabby.
Not at all.
It's also pretty actionable. I think that there are a lot of folks out there that have the ability to sock away a couple $100 here and there over the course of the month and make some major changes to their budget. Why don't we talk about a couple different places we see as possibilities for people to trim?
Yeah, I personally, there are a lot of different ways you can go with it. And I mean, everybody's situation is different. It certainly depends on how old you are, what stage of life you're in. For younger folks, I mean, I think there are programs out there today, whether it's Acorns or big banks like Bank of America, where they offer these roundup savings programs, where essentially if you buy something with your debit card and you pay $5.20, well, then the remaining 80 cents of that transaction then goes into a savings account. You'll pay $6, but that 80 cents that rounds up to 6 is going to go into your savings account. And it doesn't seem like much based on that one individual transaction, but if you look at that over the course of your daily and weekly and monthly behavior, and then look at that over the course of a year, it can really start to add up. And even though a savings account right now, and I don't think we're going to be hitting those days anytime soon where a savings account is going to earn you any kind of a return, it is a way to start getting that money socked away. And I think ultimately that's the main hurdle for most people. It's that friction of figuring out, how do I get that money saved and out of my sight? It's very difficult for someone to take money out of their wallet and then put it somewhere else and not use it, right? That's what makes the 401k plan so genius. That's what makes being able to set your paycheck up so that you can have some distributions made to an IRA or to a savings account so genius. It takes us out of the equation. Those are a couple of ways, I think, at least.
Yeah, I think if you never see the money, you almost don't feel it in quite the same way. And that's something a lot of people experience with their 401k contribution plans. But if you have the ability, you have the agency with whatever the way your payroll is set up, to be able to sock a certain amount of money away over to a checking account or savings account so that you have it come the end of the month, yeah, why not?
I was thinking about this before taping, too, and this probably plays a little bit more into folks like us. We've been working for a little while, a little bit more established, but we live in this subscription economy now, right? Like, everybody's trying to get you to subscribe to their service or their product. Every 6 months or so, go through and give yourself a subscription audit. Go through and look at all of those things that you're subscribing to. I bet you can pick one or two things out of there that you really don't use or need. And then you can say, all right, well, that $10, I'm going to put it into a savings account or somewhere else. But I've thought about that more and more, especially with kids. You run into these subscriptions that just your entire month is this just big long subscription. And if you give yourself an audit every once in a while, it's some easy pickings there.
I'm 100% on board with that. I think one of the easy ways to look to save money too is to look at the things that you pay regularly but have paid regularly for a long time. And I'm thinking specifically here about cable bills, phone bills. There are a lot of businesses that are built on the idea that we're going to give you a teaser rate. We're going to get you in with that teaser rate. 6 months down the road, 12 months down the road, you're going to be paying more. And I actually recently did this. I switched from one of the major carriers, Verizon, down to an MVNO, Mint Mobile, and I think I saved $35, $40 a month on my plan. Got very similar coverage, very similar data plan, and it was an easy one-time switch. Over the course of the year, that's almost $500 in savings. Bro, what kind of savings tips might you have?
So I'm a big fan of a budgeting rule that's known as the 50-30-20 guideline. So 50% is your must-pay expenses: groceries, mortgage, rent, health insurance, things like that. 20% is savings, and that's what I think is a good target for people. You're talking about retirement, emergency fund, college. That's that money that should be going straight into the accounts, like we mentioned. That 30% is what should be your fun stuff: going out to eat, entertainment, and stuff like that. But I think it's important to track that. So my wife and I have used an app where we have a certain amount of money we can each spend each month. Every time we spend that on a want, we add it into the app. And then we know once we've reached that limit for that month, we can't do it anymore for the rest of the month. And that makes sure that we keep the discretionary stuff within a guideline, but also make sure that we're getting that 20% of savings as quick as possible, or just ensuring that we get that 20% of savings. And I'll just add one other thing that we've used to save a good amount of money is a plugin for Chrome called Honey. Anytime you're checking something out, whether it's Amazon or a pizza place, you click the Honey app and it basically finds a coupon for you. I think you've had more mixed success.
Yeah, it's been about
it.
50-50 for me, right. but I think the point remains where, whether it's Honey or one of the coupon sites like
Retail Me Not,
I mean,
very helpful.
It's so easy to find things so quickly. It takes 4 seconds to search and try to find some coupon codes for something you might buy anyways. And if you're an Amazon customer, maybe shop around a little bit. Amazon doesn't always have the best prices.
I think that's a great point.
All right, we're going to take some live Q&A from the audience in a bit. Before we get over to that part of the discussion, though, the numbers that we were throwing out there, they are based on assumptions of 7 to 8% growth on an annualized basis. I think we need to talk a little bit about where people can put money to get those kinds of returns. JMO, why don't you start us off?
Yeah, I mean, I'm a big believer that the index fund is the new savings account. I mean, I think that for better or worse, I mean, we are in a situation now where savings accounts and CDs just aren't going to yield any kind of a material gain for investors or for people looking to save and find any kind of a return. I mean, you're talking about just fractions of a percentage point at this point. So they're great vehicles to keep money safe from you spending it. But really, if you're looking for a return, I think the greatest first step for anyone, it's not a savings account, it's the S&P 500 index fund, because that gives you immediate access to the most important index when it comes to investors on the face of the earth. 500 of the most important businesses around the world, great diversity, immediate exposure, very affordable, plenty of low expense options out there. But yeah, I just, that savings account mentality that we grew up with, I think is gone.
So often, people that are in self-directed accounts, IRAs, have that option available to them. Hopefully, a Vanguard fund. I know that you're a huge fan of that,
Right.
bro. For people that are working on kind of a limited choice with what they have available, and they are instead looking maybe directly at a 401k, maybe one that isn't run particularly well, what are some of the things that people need to be mindful of? What do they need to watch if they're trying to instantly get diversification with a mutual fund?
Right, and that's one of the interesting things, right? The vast majority of people are saving through their 401k, and you're looking at a limited selection of options. So the first thing I would say is get your colleagues together to advocate to the HR folks and the owners for a better 401k. And it can happen, so that's number one. But number two, then to look at the options. Fortunately, most do have that S&P 500 index fund, which is a great place to start. I do think it makes sense to diversify internationally, to diversify, have a little bit of small cap exposure and things like that. And there you really want to focus on costs. You can look at historical returns of a fund, and you should, but every study I've looked at basically pointed to the number one predictor of a fund's performance is costs. So get the low cost option as much as possible.
And that's what Vanguard's really well known for, right? I mean, that all along the way, we've been such a fan because that is one of the core principles of all Vanguard funds is, they're not raking you over the coals. They're really working for you, not against you.
I know that some folks are going to say, cool, I've got the 401k locked down. I'm making sure that I take care of that employer match, maybe putting in a little extra beyond that. I'm interested in some stocks. Why don't we talk a little bit about some good beginner stocks? Because I think, you want to start out with something that maybe isn't the most risky thing in the world, Jason?
Yeah, sure. I mean, we talked about at least something that's a little bit lower risk in the form of an index fund, something that follows that S&P 500. I mean, that's the beauty of that is it is very low risk from that perspective. I sort of married the idea of ways people might be able to save money or even perhaps generate a little bit of extra income with this first stock idea. There are probably a lot of people out there that have hobbies. Maybe they craft things, maybe they sew or they paint or they draw or whatever. And this company, one of these companies I follow, I own shares in it personally, Etsy. It is that marketplace. It's that online marketplace for people who like to sell their craft goods. And so whether it's some type of sewing project or some type of artwork, whatever it may be, Etsy has become the de facto community there, really succeeding in the face of what's been an Amazon world. And going through just some of these numbers here over the most recent quarter, they now have 2.3 million sellers on the platform, but 42.7 million people buying on the platform, pushing through $1.1 billion in gross merchandise volume over the past quarter alone. So you're talking about a network that's pushing through billions and billions of dollars, succeeding in what has become an Amazon-dominated world, but we know it's very forward-thinking in that they are succeeding on the e-commerce side of things, and that's all it is really. It's a network. A lot of opportunity for them to grow. It's a global business and run by a very good CEO in Josh Silverman. Still plenty of room for this company to grow. It's still a relatively small business given the market opportunity out there for today. So it would be a riskier business, but I don't want to call it a risky business. I mean, I think it is a fair sort of mid-range risk business, but they're profitable, they're cash flow positive. I mean, there are fundamentals behind this business that should have investors excited, I think.
And viewers, even if you aren't looking for individual stocks, if you're looking for recommendations for where to buy gifts, I think Etsy might be one of the best places
really,
out there.
it is a phenomenal, yeah, I mean, it is really amazing. You go check it out, you realize very quickly why they're succeeding.
My daughter made $250 with her little Etsy shop selling slime.
See?
Slime.
13-year-old.
And I went through the same slime thing. Our younger daughter, Ainsley, she was big into slime. I went through all of the work in setting up an Etsy account, and I got to the last step where they're asking for my banking information, because Ainsley was like 11 at the time, and I was like, you know what? Let's hold off for a second, and let's just see how committed you are to this. And she went through Instagram and sold some things, but the interest faded, and so we didn't have to really.
But it's a
give
good
up all
learning
of it.
experience.
It was a wonderful learning
Yeah.
experience. Very, very well-run business and network.
I'm going to be the viewer here and ask the question because I am not at the age where I know what slime is or know what it is because I have a kid. What is slime?
It is just, I mean, it is slime.
Yeah.
It is this, it's like silly putty gone bad. It
It's-
is sticky and
yeah.
gross, but kids love playing with it. I think the slime phase is fading.
It has faded. I mean, it is very similar to. I mean, you know, everybody's kind of got their own thing when it comes to craft beer or craft whatever. And this slime, like, you know, people would make up this slime would be how you identify yourself. It's like one of a kind, unique. I mean, it's made from like Elmer's glue and borax detergent. So, I mean, you're thinking these kids got to be burning their hands off or something, but apparently there was no chemical reaction strong enough to hurt anybody. And this stuff was all over schools for many, many years.
All right, enough on slime. JMO, I know you have one more stock that you wanted to talk about, and then we will flip things over to Q&A with the audience watching live.
Yeah, I mean, this is another stock that I own. I think it's really relatable for a lot of people, too. If you look at some of these numbers, 68% of U.S. households, or about 85 million families, own a pet, according to a National Pet Owners survey recently. That's up from 56%. I mean, we just know a lot of people that own dogs, cats, and other pets. Pets are just a way of life for a lot of people. And this company, Zoetis, the ticker is ZTS, but the company is called Zoetis. This is the company that makes a lot of those vaccines and medications for your pet when you take them to the vet for their checkup. So I have 3 dogs at home. I take them all the time. They get one or more of them over to the vet at any given time for a checkup, and they're getting a couple of shots, a couple of blood tests, and all this stuff. They've got a diagnostics wing of the business as well. Zoetis is a big part of that visit. So at least when I'm forking over that bill for that vet visit, at least I know I'm kind of paying myself because I own some of those shares of Zoetis. But I mean, it is really amazing. You know, we think about our human healthcare system and how insurance makes it so difficult, so nebulous, and so difficult to understand. I mean, the pet industry is really a cash business. I mean, there are pet insurance products out there, but overwhelmingly it's a cash business, which makes this market a lot more attractive because the financials are very easy to understand. Zoetis is the far and away market leader in what they do. Global business, very diversified, just a lot of things to like about it, and certainly a lower risk. And on top of it all, bro, they pay a dividend.
Nice.
So if you own the stock long enough, you can
do like
really feel
dividends.
that compound action working for you.
I have to confess, I didn't know what Zoetis was before you told me this is what we were going to be talking about on the show. And I went and I looked at the stock chart up and to the right.
They
Really nice.
spun out of Pfizer not terribly long ago, and Pfizer, as we know, is another big business in the human healthcare industry. But Zoetis, it was nice that they gave Zoetis the room to kind of go off and do their own thing, and they've been very successful thus far.
All right, we are going to switch gears and take questions live from the audience. If you are interested in getting some more stock ideas, you're just getting started investing, head over to fool.com/start, get our investing kit, 5-stock sampler to get you going. I want to start with one question that was actually from a comment on another YouTube video. This commenter said, I hear you guys on getting started investing now, but I have credit card debt. Which one comes first? This seems like a Robert Brooke.
Yeah, it's a difficult one, right? So the average interest rate on a credit card these days is 17 to 18%, and if you don't have a great credit score, it's even higher. So from a numbers perspective, it always makes sense to just pay that off first. That said, if you have a 401k at work and you get a good match, I would say at least take advantage of the match because you're getting that free money, plus there are tax benefits to the 401k. So I would do that first. But otherwise, do everything you can to get rid of that credit card debt. Because it's hard to grow your net worth if your portfolio is growing 8 to 10% if your debt is growing at 17 to 20%.
You don't want compound interest working against you.
Exactly. That's exactly the way it works. They're cutting down your trees.
Yeah, you don't want that. Whitney asks, any encouraging words for those of us in our early 50s who started investing late? Where can I buy a time machine?
I mean, the time machine, I think, is probably the one thing most people I know when they get started a little bit late, that's what they want, is just a way to go back even 10 years. And I think, I will say this, I think that as we get older, and I'm closing in on that 50 number myself, I do feel like we get more patient as we get older. And I think that is a big advantage, especially when we talk about the fact that time really is our buddy here. And, you know, 50, hey, listen, what was it, bro? You recently said, what was it, 70 is the new 50 or something like that?
70 is the new 65.
I mean, we're talking about people working longer and longer anyway. So if you can sit there and look at your life and say, I don't really want to have to worry about achieving my financial freedom until I'm 70, that puts things, I think, in a little bit better context. And then all of a sudden, you can use your wisdom and say, well, I can be patient. I don't have to do anything rash to try to make up for lost time. That, to me, is one of the bigger advantages of getting older, is you do have a little bit better perspective, and you can exercise a little bit more patience.
Yeah, the good thing about being over 50 is the contribution limits to 401ks and IRAs goes up, higher limits. The kids are out of the house. Once you stop paying for college tuition and all that stuff, don't start spending that money. Just take that money that you were spending on your kids and get them into their retirement accounts.
Yeah.
And there's no question that you can solve a lot of problems by delaying retirement to age 70, because it's more years of adding to your accounts, more years of the accounts growing, and a higher Social Security benefit because it goes up 8% for every year you delay.
I guess that actually sets us up for a really good follow-up. What do you guys think of risk tolerance over time as you get older, right? Because so much of what we're talking about here is being somewhat invested or fully invested in the stock market to get that 7 to 8% return we're talking about. How do you change that as you get closer and closer to needing to draw on those funds?
So I'm the advisor for our early retirement service, and we have model portfolios. And once you are within a decade of retirement, the portfolios have about 25% of the assets out of the stock market, and then 40% out of the stock market once you're retired. That's just for the average person, moderate risk tolerance type of person. You could have more in the stock market if you have something like a pension or something like that, or an annuity, because those act as sort of like bonds. But I think those are good guidelines. And you can gradually do that. So I think one way you can do it is, once you get within a decade of retirement, rather than reinvesting your dividends, let them accumulate as cash or get invested in bond funds, so that by the time you reach retirement age, you've built up a nice, what we call an income cushion. Basically, it's money that's out of the stock market, so you can withstand any bear market that'll happen in your retirement, because it will happen. And you've got to have some money to live off while the stocks recover.
Dividends have come up a couple times. We have one viewer asking us, are DRIP plans good for individual stocks? And I'll just take that acronym out, dividend reinvestment plan. And I guess it probably depends on what your investment goals are. Jason, what do you think about that?
Yeah, I mean, it is another way to sort of set it and forget it. I think that if you're looking for the type of investing strategy where you don't have to worry about things, you don't have to do a lot, dividend reinvestment programs can be very helpful. It's essentially doing the work for you and making sure that you reinvest those dividends that you're getting from your shares. So I do think they're helpful. I think the flip side of that is, perhaps you're like me, I'd rather have that cash and be able to consider adding to different stocks in my portfolio that I'm following. But you know, it also definitely depends on what stage of life you're in. I mean, are you in grow your wealth mode, or are you in protect your wealth mode? Because that can certainly help dictate it as well. I think if you're in grow your wealth mode, well, maybe getting that cash and reinvesting it on your own terms makes a little bit more sense. But if you're really looking to protect your wealth, maybe the dividend reinvestment program makes a little bit more sense, because it takes some of the thinking out of it, which is nice.
And certainly, if you're banking on getting the cash, you want to sidestep the dividend reinvestment program,
Yeah.
because otherwise it won't be coming your way. We have a question from Paul. He asks, besides maxing out contributions to your 401k, what else can be done to help reduce taxable income in a given year? Robert, any ideas there?
Well, there's one thing we like to do here at the Motley Fool, we'll talk about, is tax loss harvesting. So of the investments you have outside your retirement accounts, if they're below the cost basis, the point at which you bought them, you could sell them, and that could be used to offset gains, or up to $3,000 of income. That's one way to do it. Other things is just to make sure you're maxing out your 401k. That's the most important.
That's the biggie.
That's the biggie. It really is. And the interesting thing about the new tax law that came out in passed at the end of 2017, right? Most people did get a tax cut, but it took away a lot of the deductions, and it increased the standard deduction. So a lot of things you used to be able to do to cut your taxes, you're just not able to do, because you just get that higher standard deduction. For example, like a third of people used to itemize, now only 10%, because it's just not worth it anymore.
Yeah, I was going to say buy another house. You know, that's one thing you could do. I mean, we as for a time we had a rental property that we managed, and it was interesting to see how you could use that to your advantage. I mean, I'm no tax expert, but we had a tax guy that worked with us on that. But yeah, I mean, the tax laws seem to constantly change, and as soon as you put yourself in one good position, that law goes back against you, and you're not necessarily in the same position. So once you buy a house, you're probably going to be stuck in it for a while. So make sure that's the decision that's right for you before you do it.
Yeah, I'll add something that if you don't want to invest money in the stock market for any reason, like you feel like you have enough invested, or you're worried, you're looking for a safe alternative, but you don't like cash and bonds, a great strategy is paying off your house before you retire. Yeah. Because when you're in retirement, for every dollar you spend, you increase your taxes. Why? Because every dollar you spend, you got to take more out of your IRA or your 401k. So you take out $100 and you're in like a 20% tax bracket, you're just going to increase your taxes by $20. If you pay off your mortgage before you retire, you've lowered your expenses significantly, and you can live on a lot less money, which is great, but it's also going to lower your tax bill.
Okay, our next question comes from Stuart, and I think you guys are both very qualified to answer it. It gets at something that I think you've both done. I have a 2-year-old and a 3-year-old. What do I do to invest so they can be ahead of the game when they turn 21? Jason?
It's a great question.
Jason's
I mean,
great. We both have done podcasts.
Yeah.
And Jason's great at it.
I'm very lucky just in that my parents taught me about investing at a young age, so it just interested me that you could make more money with your money, and it stuck with me. So yeah, I have 13 and 14-year-old daughters now, but we got them started investing when they were, I think, 6 and 7, something like that, and it just stemmed from going into a Panera one day and me telling them that we actually owned a part of it, and they just were fascinated by that.
Did they try to go get a free bagel?
Well,
like, hey, I own
this is my dividend.
I did say, you see that napkin on the floor over there? You could pick that up if you want. I mean, it's kind of your place, really. And I think ultimately, what we wanted to do was give them a head start. We talk about time a lot, and really that time is extremely valuable, particularly at that age, because believe it or not, my kids don't want to sit here and talk stocks with me all day. Dylan, as much as I wish they would, it's only a once in a while thing. But that's kind of the point, really, is you get them into it at a young age. They're kind of ignoring it anyway. And so we would take tooth fairy money, birthday money. My wife and I would help them out a little bit. We talk about birthday gifts we would give them, or Christmas gifts. I mean, stocks make wonderful Christmas gifts for kids, at least from a parent's perspective, because they don't require batteries. You don't have to pick them up off the floor. But a couple of things we did. We opened an individual account for each of them. Okay, it's just like opening a savings account, a UTMA or a UTMA or UTMA?
Or
UTMA,
most states are
and all that is saying that the child is the owner of the account, but I'm the custodian, right? And so I'm maintaining that account for them until they hit the age where they can actually own it themselves. But I gave them each their own account, and I didn't want to combine them because then you have to deal with splitting it up, and there can be some tax implications there, particularly if you got some stocks that have done really well over the course of 15 years. And from there, it is just a matter of talking a little bit about the different kinds of companies that they like, the ones that we witness every day. Building a portfolio around those ideas, the companies that they like, the Under Armour shoes, the Nike shoes, the Apple phones, the Netflix account, the Amazon stuff, anything that kind of comes into our lives on a daily basis is really fair game. And every time we buy one stock for them, that's it. The next time it has to be a different one, and that simply teaches them the value in diversifying your portfolio. And so fast forward to today, they have portfolios now with about 12 or 13 holdings in them each. We check on them every couple of months, maybe just to see what's happening. But the concept is there. They're seeing their money compound and grow, and it's a very powerful lesson. And the goal is ultimately not for them to become rich. I mean, I hope that they do, but it's really just to give them the tools so that when they are adults, they can at least make an educated decision. I'm not going to be able to control what they do, but at least we know that we gave them the tools to make the decision that's going to work best for them.
I think the advice for getting a kid started investing, we actually got a follow-up question from another viewer. I think you answered it very well. It's very similar to getting a new investor excited about investing, right?
Yeah.
We talk so much about how you need to buy a business that you understand and know well. One of the very common ones for a lot of people is Starbucks, right? It's something you see, it's an easy thing for you to wrap your head around. The lesson's the same, I think, with kids. If they love Disney, they're going to be excited if they go to the movie theater and say, I'm getting a fraction of some penny that I'm paying for the tickets for the show that we're going to go see.
It's a very cool concept. And back to your point on kids, I think that in most cases that works. I mean, I can tell you from my time in the golf business, I taught a lot. And it was always a lot easier to teach golf to kids. They had more of an open mind and less frustration that came about. They saw the challenge and wanted to attack it. Adults can sometimes be a little bit more difficult to really teach from the very beginning. And I'm not saying it can't be done. I'm just simply saying that when you get kids younger in life to understanding these principles and getting them invested, I think it tends to stick a little bit better. And again, it gives you a lot of extra time, because if you get a kid started at 5 or 10 years old, I mean, 10 years may not sound like a lot of time, but as an investor, it is a lot of time.
All right, I think we have time for maybe 2 more questions. One of them comes from someone who says, I day trade and I make a small amount of money every day. How can compound interest help me earn more? And I actually think that this is a great chance for us to kind of look at how compound interest works for you. A big part of it is being invested.
Right. Well, so I guess we should make it clear that generally we here at the Motley Fool aren't big on day trading so much. I would just say if you're day trading, just track your returns to make sure that it's making worth it, and talk about something that can quickly generate a lot of tax bills.
Yeah.
So you have to take into account the after-tax
Yeah.
consequences of it.
Yeah, the day trading data seems to show that it's a very tough thing to do consistently well. We are generally long-term buy and hold folks here at the Motley Fool, and I think that a lot of people seem to get compounding working on their side a little bit more often that way.
Yeah.
We're going to wrap up with one more question from a viewer. They ask, how should I prepare for the next recession? Do you recommend I be fully invested or keep some cash on the side? And I think that this is something a lot of people are wondering about. You know, you look out at the big macro picture. There's a lot of scary headlines. I work in our editorial department. I know all about them. You know, there are a lot of things.
Some of them.
I'm sorry. We're trying to educate here. And so a lot of people are looking at things like the yield curve inverting. You know, at negative interest rates, and they're getting a little frightened. Jason, what would you say to someone who's asking a question like that?
Well, I mean, first and foremost, we talk about this all the time on our podcasts and radio shows, that it's when it comes to a recession, it's a matter of when, not if, okay? You have to expect the recession. It's going to happen. And I was reading recently on Bro's wonderful Rule Your Retirement site an article where he had quoted a factoid that went all the way back to 1865. And it talked about the fact that we've had a recession every decade since 1865. And we are getting ready to wrap up this decade here in just a few months. And we've not had a recession here this decade. Now, we obviously went through a pretty big one right before the beginning of this decade. But the point is, we are getting ready to wrap up a decade where we may not actually have a recession. I don't know that that really matters to me, because I feel like the recession will happen eventually. And as an investor, having gone through the Great Recession, that was probably the single greatest experience as an investor for me. From a learning perspective. I mean, I learned a lot about not only the mechanics, the headlines, how to deal with the emotions, how to prepare for it. Really, for me, the two things that I walked away from is make sure that you have access to some capital to invest. Okay, so always keep that dry powder, that cash in your account. I know people always want to ask, well, it's just cash, it's sitting there. I get that, but you got to understand the return is the liquidity, okay? The return is being able to put it to work at a moment's notice. And then from there, you know, I mean, focusing on just investing in those good businesses. Don't worry about the flavor of the day. I mean, that's one of the things I love about our style of investing, is that we're focusing on these businesses that just continue to do great things over time. And David Gardner always talks about that adding to your winners mentality. I mean, these winners keep on winning for a reason. They're great businesses. I don't know that there's really a bad time to invest in an Amazon or a Starbucks, as long as you have the appropriate timeline. And if a recession comes and you see these great businesses on sale, you got to be ready to jump in, so have that watch list ready.
And I'll just add that over the last 11 recessions, the unemployment rate has gone up about 2.5%. The last recession, it doubled from 5 to 10%. And really so the point is, one of the biggest economic impacts of a recession is many people lose their jobs. So if you're worried about a recession coming, make sure that your job is secure and have a good emergency fund on the side, that in case anything does happen to your job, you're ready to weather that.
All right, I think that's going to do it for this broadcast. Jason, Robert, thank you so much for joining me.
Thanks.
And thank you to the viewers for asking all these awesome questions. It's great having a lively and vibrant Q&A. If you're interested in that investing starter kit that I mentioned, you can grab that over at fool.com/start. You mentioned the emergency fund, talks about building that emergency fund, talks about making 401k decisions, gets you to the point where you can buy that first stock, and gives you 5 starter stocks as well. And if you haven't already, give us a thumbs up. Be sure to subscribe to the channel. You get all the great content we're putting out here. Until next time, I'm Dylan Lewis. Thanks for listening, and Fool on.